Imagine waking up one morning in a quiet African village and discovering that the land your ancestors farmed for generations has been leased to a company from China. Across the ocean, in Brazil, Argentina, and even the United States, similar headlines are appearing. Chinese investors buy farmland. Why is China so interested in foreign soil? What are they growing? And what does it mean for the rest of the world? Today we dive deep into the global agricultural land rush and the powerful strategy behind China's investments abroad. Since the early 2000s, China has quietly become one of the world's most aggressive buyers and leasers of agricultural land overseas, from Africa to Latin America and even North America. Chinese investors, both private companies and state-linked enterprises, have been signing long-term deals, leasing vast tracts of fertile land. Let's start with Africa, where this story is most visible. In Tanzania and Mozambique, Chinese companies have invested heavily in rice and cotton farms. In Zambia, they've established what they call friendship farms, joint ventures between Chinese agribusiness firms and local governments. In Ethiopia, Chinese-backed firms are growing sesame and sugarcane. And in Sudan, Chinese investors have been involved in major irrigation projects tied to the Nile River. Across the continent, Chinese agribusiness is spreading, often wrapped in the language of cooperation, modernization, and Belt and Road development beyond Africa, China in Latin America and the West. But Africa is not the only region where China's agricultural footprint is expanding. In Latin America, Chinese firms have targeted Brazil, Argentina, and Venezuela, countries rich in soybeans, corn, and beef. In Brazil, Chinese companies like COFCO International have bought stakes in soybean farms and grain trading terminals. In Argentina, Chinese investors explored leasing 2 million hectares for soy production in 2011. Though not all deals materialized, the intent was clear: secure long-term access to food and feed. Even in the United States, Chinese investors hold about 384,000 acres of farmland, less than 1% of total foreign-owned land, but enough to trigger political concern. Some of that land is owned by Chinese meat processing giant WH Group, which also owns the American brand Smithfield Foods. Why is China buying farmland abroad? To understand China's motives, we have to look inside its borders. China has 1.4 billion mouths to feed, but only 7% of the world's arable land and just 6% of its fresh water. Decades of rapid urbanization and industrialization have polluted large parts of its farmland. Meanwhile, rising incomes mean people are eating more meat, milk, and processed foods, all of which require huge amounts of grain to produce. Beijing's leaders see food security as a matter of national survival. A drought, a global price shock, or a conflict that disrupts supply chains could threaten social stability at home. So instead of relying entirely on imports, China is building its own food security network by owning or controlling production abroad. It's not just about growing crops. It's about controlling the entire value chain, from farms to shipping ports, storage silos, and global trade routes. The economic and strategic logic. There's also a strong investment logic. Farmland is one of the world's most stable assets. It appreciates over time, even during economic crises. By investing in farmland abroad, Chinese companies diversify their portfolios and reduce risk from domestic market volatility. But this isn't purely about profit, it's also about influence. Many of these investments are tied to the Belt and Road Initiative, China's $1 trillion plan to connect Asia, Africa, and Europe through trade and infrastructure. Agricultural projects serve as diplomatic tools, strengthening China's soft power, building goodwill, and giving it access to resources that might become critical in the future, especially water. How it works on the ground. In most cases, China doesn't buy the land outright. Instead, it signs long-term leases, 20, 50, sometimes 99 years, with host governments. Chinese farms then bring in machinery, irrigation systems, and sometimes Chinese labor to cultivate crops like rice, cotton, and corn. In Mozambique, for instance, Chinese-backed farms have introduced hybrid rice varieties developed in Hunan province, boosting yields but also raising concerns about seed dependence. In Zambia, Chinese friendship farms aim to train local farmers and modernize agriculture. And in Ethiopia, Chinese companies have invested in large-scale sesame and flour farming for export to China and Europe. These projects often come packaged as win-win partnerships, combining aid, investment, and technology transfer. But on the ground, the reality can be more complicated. The controversy: land, water, and local livelihoods. Critics call it land grabbing. They argue that while China gains food security, host countries risk losing control of their land and water. In Tanzania and Mozambique, local communities have complained that promised jobs or compensation never fully materialized. Some farmers say they were displaced or pushed onto less fertile plots. Environmentalists warn that intensive farming practices, especially monoculture crops, can degrade soil and overuse water. And there's another risk: food sovereignty. In some cases, the food produced on these Chinese farms is exported, leaving local populations still vulnerable to hunger. So, while China secures its food supply, host nations may not gain true food security themselves. The African example and lessons for Kenya. For Kenya and other African nations, China's agricultural investments are both an opportunity and a warning. They bring in technology, capital, and infrastructure, but also questions of ownership, transparency, and benefit sharing. If handled wisely, partnerships can boost productivity and open export markets. But without clear land policies and local safeguards, countries risk losing control over their most vital resource, land. Experts say African governments should demand fairer deals, shorter leases, and ensure communities share in the profits. Because once the land is gone, it's gone for generations. China's global farmland push tells us something profound about the 21st century, that food, like oil, like data, is power. From the rice fields of Mozambique to the soy farms of Brazil, the world is being quietly reshaped by a new kind of geopolitics, the geopolitics of the soil. Whether this leads to prosperity or conflict depends on how nations manage it. Because in the end, whoever controls the food controls the future.